everyone. Welcome to our monthly macro and market discussion, where today we discuss the key global and domestic events for November 2022. Do you know the best performing equity market this year? Well, it is India. Amongst the key market, Nifty has delivered the highest return between Jan to November. And if we correct for the currency, it is perhaps the second best after Brazil. And yet, we are cautious ahead. We will discuss why. On the global front, October US CPI printed its first sub 8% and lower than market expected inflation in many months. This, coupled with Powell's latest speech, drove market cheer toward risk assets and treasuries, and also including Indian equities. But given the internal constructs of inflation in the US, wage growth, and retail sales, risks are still skewed towards a higher terminal rate than current 5% market expectation. Labor demand is cooling, but not as quickly as the Fed would like. Has the USD peaked is another question we repeatedly face. Historical precedence is not on the side of USD bulls, following 20% year-on-year rallies. Usually, the USD peaks after such a performance. That said, there might be one final leg to the highs in the DXY. Somewhere through 2023, once Fed pivots firmly, USD strength could come under question. Now, officials in China are working hard to relax the strict COVID guidelines, particularly given the rising social pressures over there. But with limited vaccine penetration and efficacy, COVID cases continue to flare up in China. And this means that there could be serious accidents prompting step backs in the opening up policy over there. As for the property sector, recent measures are focused on providing liquidity to property developers in China so that they can finish their projects and financial contagion is avoided. Home sales stay weak. The bottom line for us is that the strength of Chinese recovery in 2023 is still under a big question. Now domestically, India's Q2 FY23 GDP came in at 6.3% year-on-year, in line with expectations. Investment activity was strongest, followed by near 10% year-on-year growth in household consumption. Government revenue expenditure declined sharply, perhaps explained by the weakness in state spending. For the second half, we hope state spending to improve. Household spending will continue to recover and overall investments should still hold up, while exports moderate. But heading into FY24, we expect growth and earnings to moderate. Household sentiments and income are improving, and as inflation cools, real household spending should continue to improve further in FY24. But exports are rapidly moderating. Global growth and trade moderation may stall the capex momentum despite the solid balance sheet for domestic banks and businesses, policy push, and project pipelines. Despite the risk-on sentiments in the last 2 months and strong rally in Nifty, the global backdrop isn't favorable. De-rating of global equities driven by higher bond yields and higher equity risk premium is likely to remain a risk going forward. Valuations suggest that equities are expensive relative to bonds, and in Indian equities is priciest amongst the EM baskets. Near-term earnings also face some risk. As such, macro narrative isn't in favor of equities. It is more about stock selection in the current environment. Now, coming to the fixed income market, we are firmly positive on the fixed income assets and have built up duration in our portfolios. There could be bouts of interim volatility, but directionally we are headed towards lower yields 6 to 12 months from now. Globally, we are in the mature stage of rate hiking cycle. Similarly, In India, cumulative tightening has been rapid and substantial since April 2022. Overnight rates rose by 300 basis points this fiscal. We may be left with a one or two more hikes going ahead. Any global shocks aside, inflation in India is heading towards 5% in a matter of few months, aided by favorable base, peaked commodities, and a breather in the core inflation as well. Kharif food output has not been as bad as feared, and Rabi prospects look favorable thus far. Recent RBI commentaries have also suggested that it is ready to accept a low positive real yield, and hence RBI may not fight aggressively towards a 4% central target. Balance of payment and rupee is still one of the risks hanging in India's macro picture. Liquidity has tightened considerably and stays under pressure going ahead, given our worry on the external account deficit. Short-term rates could rise further. Credit to deposit growth gap has widened and it has tightened significantly, which could drive down SLR investments by banks. To some, demand supply may warrant some bit of caution, but overall, fundamentals are turning favorable. Finally, looking at the valuation, GSEC yields are attractive in absolute terms and relatively better than other investment options. This broadly explains our positivity on debt products. SDL supply throughout this year has underwhelmed market expectation. SDL supply and hence spreads could stay anchored even in quarter 4 as there are multiple tax and non-tax transfers pending from center towards state. Corporate bond spreads, though still tight, are getting better in select segments. Signing off for this month. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.